don't have such a high percentage of your household income go. Give yourself some margin. I mean, people do what they have to do. But if I were to do it again, and I know that ever since that time, what I've paid in a mortgage has been a lower percentage of the income.
Hello, and welcome to Real Loan Talk, the podcast where we unlock the secrets of creative financing and real estate. Hosted by Sonya Morgan from S.J. Morgan Private Lending Exchange. This show is your go-to source for expert advice on mortgages and real estate investments. Whether you're buying your first home, managing your investment portfolio, or considering a reverse mortgage, Sonya's insight will guide you through the process. Get ready to learn, grow, and achieve your financial goals. Let's dive into today's episode.
Welcome to Real Loan Talk with Sonya Morgan, broker owner of S.J. Morgan Private Lending Exchange. We're super happy that you joined us today, and I'm excited to be talking to Mr. Joe Morgan, who is also the co-owner of S.J. Morgan Private Lending Exchange and an investor who has invested in private money notes. Welcome.
Hi.
Yeah, it's good to have you. And so I like to start my podcast with a dad joke. Do you have a dad joke for us today?
I didn't realize that this meant a dad joke that I had to tell. I don't.
Oh, yeah, I know. I didn't ask you to tell one because I knew you would say no. But I have one for us today. So are you ready for the dad joke?
Yes.
Where do you take someone who has been injured in a peekaboo accident? To the ICU. Okay, anyways, I'm just sorry. That one was funny. I thought we'd like that one because we have grandbabies.
Start.
Okay, anyways, welcome today. We're so glad that you joined us. So you're very serious, so we had to start with a joke. But anyways, I also want to start the podcast talking about the first time that you bought a home, because a lot of people that are watching this podcast are first-time home buyers. And I have noticed that a lot of first-time home buyers are afraid to buy a home and thinking that it should be easier than it is. And so I want to ask you a few questions about the first time that you bought your home. Do you remember the first time you bought a home?
Yeah, Tracy, about 1989, somewhere around there.
Okay. What kind of loan did you use when you bought your first home? Do you remember?
It was a VA loan, as I recall.
A VA veteran loan. Okay, which is an amazing loan to have, but it definitely has a few challenges. But do you remember any of the terms of your loan, like what the interest rate was?
I do not. I don't remember what the interest rate was. I remember that we went quite a bit. I was making probably higher mortgage payments than I would do today as a percentage of.
Okay. Okay, so that would probably mean that the interest rate was significantly higher because you probably bought the house for much less than what you purchased the house for last time, most recently.
Yeah, I don't know. You probably know what the interest rates were back in 1989, 1990. You probably have a better idea than I do.
I wasn't in the industry then, but I did buy a house in the early 90s, and I remember the rate being around 7.75 or something on an FHA loan, and usually VA is similar. So I'm guessing they were in the 7 to 9 range just on a normal basis back then.
Yeah, it wasn't what we just came from. It was nowhere near just recently had.
And how much money did you have to put down when you bought this house?
I don't remember there being a significant down payment. I think that the loan was pretty low down payment. It wasn't enough. It was a punch in the gut because we didn't have a whole bunch of money at that point. So it couldn't have been low 5 figures.
Okay. So that's definitely one of the benefits of a VA loan is that you have a funding fee that can be wrapped into the loan and you don't have to come in with money down. So you're typically coming in with closing costs. So even though you had a higher payment, you didn't have to come in with a lot to buy the house. Right. Yeah. So how did you feel? Like, what were your emotions when you bought your first home?
Well, I felt a huge sense of responsibility because both of my first spouse and me were both working full time, and I had the larger salary, and the mortgage payments took about 50% of my pay. So more than a quarter, probably closer to a third of our income was that mortgage. So aside from that, though, I mean, I was really thrilled because lived, I had moved a lot as a kid and as a younger adult and had rented a lot. And I was thrilled to have bought a house. So I used to sit in my lawn chair and surveil my lands, my whole backyard like I was a king.
Yeah, we were just talking today in a meeting about just coming through 4th of July and how the American dream and how the early pioneers gave their lives up to get property. Like they didn't have any money to buy property and they didn't have really the ability to have loans. And so they just like raced across, the country trying to do a land grab, and here we live in a land now where we can get a loan and, so we can survey our lands, but it's an easier process, but still scary nonetheless. Right. Yeah. So, so you had mentioned that you thought that your first payment was about 2/3 of what you were making. And I think a lot of people perceive that because when we qualify people for a loan, we go off of their gross income. And so we can oftentimes qualify them up to, 50% of how much money they're making gross. But if you were looking at your net, like after the taxes were taken out, it probably would feel like a lot more than 50% of what you
Yeah,
were
it was
making.
it was probably 50% of my personal net income.
Mm-hmm.
It's
Mm-hmm.
probably more than a third of the household income.
Okay, yeah. And so was that kind of scary for you when you were first making your house payments?
A little bit. But yeah, a little bit. When I was in the Marine Corps, our rent was probably the same portion of our income, but we had things like housing allowance and it was a rental. So if
Mhm.
it failed, we would just move on to another rental. But
Mhm.
once we purchased a property and we had a mortgage, then it felt a little more significant.
Mhm.
Uh, but we were pretty disciplined. We worked pretty hard. We just couldn't lose a job.
Mhm.
So,
Yeah.
it was always in the back of my mind.
Yeah. So you definitely made sacrifices to own property.
Yes.
Mhm. So
Yeah, our
what have,
disposable income was reduced significantly. We weren't, you know, going places and buying frivolous things. We were definitely starting to watch our finances then.
okay. And and what advice would you give somebody who was thinking about buying their first home?
Yeah, don't have such a high percentage of your household income go. Give yourself some margin. I mean, people do what they have to do. But if I were to do it again, and I know that ever since that time, what I've paid in a mortgage has been a lower percentage of the income.
Okay.
We were pretty, I know when you're young and you have limited income, you're really inclined to do that more. But if you're not super disciplined and you're not, then you probably should give yourself some more leeway.
Yeah, that's good advice.
4 to 5, 6 years where there was no goofing around. We basically had to stick to the plan
Mhm.
and it lightened up. The level of payment reduced as incomes went up. And so the pressure started to relieve, but it took a while.
Yeah. And that's honestly a very common message and story from people who buy their first home. It feels like a lot of pressure at first and it starts to relieve itself. And if you're somebody who's fortunate enough to have a mortgage for many, many years, there comes a time when it feels like it's pennies, that you're paying on a mortgage,
Yeah, I
so.
can remember my dad back in the mid 80s. He lived in Milpitas, and I asked him what his mortgage payment was. And he told me it was $262. And it just blew me away. I thought, wow, I'm making $1,750 payments on a
Mhm.
house, and he's making 262. And that's because he did exactly what you said. He stuck with
Mhm.
it, kept making his
Mhm.
payments, his income went up, and you know, prices, all the equity and such builds up. And so by the time he got done with that loan, with that mortgage, it was nothing to him.
Mm. Yeah. Yep. That's how it works. So, well, thank you for sharing that first experience. And just before we get started talking about the creative lending products and the ways that you've invested, have you purchased other homes since then?
Just the ones we've purchased.
so,
I don't have any
so
secret houses.
so you've owned multiple homes in your,
Yes.
you've continued to be a home owner. So yeah. Okay. So, so today we're talking about private money investing. So I want to focus more on the people who are thinking that maybe private money investing might be a good idea for them, and there's multiple ways to do that. And one of the ways that you have invested in private money personally is through utilizing your IRA, which is a self-directed IRA. So you've taken your retirement and you've moved it into a self-directed IRA to invest in real estate. So, can you speak a little bit to what that looked like for you? Like, how difficult was it for you to move funds into a self-directed IRA?
It's pretty easy. Generally, in theory, it's pretty easy. You just sign up, and the entities that do the transactions, that sponsor the transactions, I can't think. Pensco always comes to mind, but I can't think of even the one we're in now. They are very helpful as far as directing you and instructing you in what to do. And so you're not doing it completely, or even you're not doing it on your own. So it's not a difficult thing to do. You just have to sign up.
Okay. So if you had funds like in a self-directed IRA that was in stocks or in bonds or different things, you would have to sell those out and liquidate them and then move them into a self-directed IRA for purchasing real estate, correct?
Ooh, I don't know. I know that the way that I did it was I moved it was an E-Trade. Some of it was an E-Trade and some of it was held by, I don't remember the retirement company, the entity that had it, but it was just funds that were sitting in that account and they were transferred over to the self-directed, to the REIT or whatever.
Correct. And so when you're utilizing E-Trade, that's like a self-directed IRA as well. Like your money's in there and that helps you send your money into stocks and bonds. But when you move it into a self-directed IRA for real estate, that fund actually helps you purchase real estate instead of stocks and bonds. Right. Yeah. Okay. So once you moved your money into the IRA to fund real estate transactions, what were some of the criteria that you determined that you were going to use when you were deciding what to invest in?
I think the first thing out of the gate is I wanted collateralized investments. I didn't want risk because it is retirement funding and I didn't want to take chances with that. So if I were going to invest in a piece of real estate, buy a note, for instance, if that went into default, I wanted to be able to recover my money in that property. So that was probably the first thing.
So what you're talking about is a good equity position. So you wanted, like, if the property was worth 100,000, you wanted to maybe lend 50,000. You wanted to have a lot of protective equity. Is that what you're saying?
Yeah, I wanted to know that if the transaction went south, if something happened with this property, that I'd be able to get my money back out. And so I guess that translates to low risk and as much potential profit as possible. So with private money, you're talking about interest rates that are a little bit higher and typically shorter term. I think in the beginning, I thought that shorter term was more desirable. But after having done it for, I don't know, a decade or so now, I don't think it really matters what the term is. In fact, sometimes the longer term investments are less of a hassle. If you're pulling your money in and out, buying a note, selling a note, buying a note, selling a note, that gets to be tiring. It's not like trading stocks. It's a little more involved. It's simple and people guide you through it, but it takes a little bit of time each time you do one.
Yeah, that's good advice. You actually, one of the notes that you had in the beginning was a low risk because had a lot of equity protection. But the borrower, through the years when they had it, kept paying the note down. which is unusual for private money. Typically, private money, they just pay interest only. And so that was, it kept chunking money back to you over a period of time. How did you feel about that note when you had it?
Yeah, I think that in my mind, I don't know if this is accurate or not. In my mind, it felt like a positive because it seemed like these people had the intent to keep possession of this. They were serious about wanting to own and possess the property. And they were making regular, uh, obviously beyond minimum payments. Um, I don't think they ever missed. I don't think they were really even late on one.
Mm.
So I was almost sorry when that transaction ended because it felt pretty dependable.
Yeah. So that's like, so you have different in private money, you have different investor emotions and feelings, and so some investors want a higher interest rate and they're willing to take more risk. And what you're saying is because this is your long-term retirement plan, you will take a lower interest rate for a lower risk and you're okay to be in it for the long term and just let the money sit in there and work.
Correct. Well, the way the economy is now, I think the smartest money I ever made was in the stock market back in the 80s and 90s, but that just doesn't exist anymore. You will never, at least I am not aware of anything that's available to me that garners more safe profit than the REIT, than the real estate investment trust.
Yeah. So, I mean, that's like actually a really natural, good question is how have your private money notes uh, performed when set alongside how your stocks were performing at the time that you switched them over?
Yeah, I jumped into the stock market back in the 80s where it was very bullish. There was a lot of money to be made. You could make 20 to 30% on an investment. Some of those positions I held, I made 20 to 30% in just a couple of months. Unfortunately, I didn't have a lot of money to play with back then, or I could have really made a lot of money. But that kind of went away. I found that, when the economy started getting tougher in the last 10 years or more, roughly 10 years, I was working 20 minutes a day, and I was close to breaking even in the stock market. I just couldn't seem to make that same kind of profit. With the real estate investments, I'm making anywhere from 9 to 12% generally, and it's just consistent. And it's once you have the position set up and you have the property and everything's lined, the loans issue, you really don't have to do anything. So
Okay.
it's effortless. There's no 15 or 20 minutes a day. That's really what made me sour on the stock market. I mean, I guess if I day traded and I sat there and studied it and researched it, and that was my job, I could probably make it. But it's not. And I don't want to do that. I don't want to spend 20 minutes or 15 minutes or an hour on the internet, every single day to maintain those. And, I found it got so volatile at points that I was putting stop losses in on my positions, and the stocks were dipping and climbing so quick that they would nullify the stop loss. And so I felt like I had a part-time clerk job just to maintain the 10 or 12 positions I was holding at the time. So it just became a hassle.
Yeah. So, I mean, I know that you have the benefit of being, part owner to the company. So when you have funds available, I typically bring you what I know you're going to like, like personally, you get personally delivered to you. Like,
I know somebody in the business.
Everybody else has to get in line because that's typically how it works. It's like whoever says, first. But if I know that there's a little bit of money sidelined for you, then I'm like, hey, like, how about
the
this
REI? If you want the real estate investment inside, then you're going to have to bury mortgage broker, I guess.
I guess. So we have plenty of clients that do quite well with their private money also. But so you have it
first if you don't want to wait long.
You want to be first, yeah. So you haven't really had the opportunity to say like no to something. Like I haven't brought anything to you that you were like, absolutely not, I'm not going to do that. But if I did bring something to you, like, is there something that you would be like, I don't want to fund that? What would make an investment a no for you?
I would say I'd like to be diversified if it took more than 50 or 60% of the funding I have. One of these jumbo loans or one of these, higher end loans. I would be uncomfortable with that. I would be uncomfortable with inordinate risk. But I just don't, most of these are collateralized. Most of these,
Mm-hmm.
it's a win-win, most of these transact. The ones that are based on the purchasing notes, like what I'm doing,
Mm-hmm.
um, they're pretty secure. So,
Okay.
and they're pretty effortless once you have them set up. So I
Mm-hmm.
don't, it would have to be something just so that would, just occupy so much of my account, or something that I thought for some reason was risky.
Okay. That
But
makes sense. I mean,
I haven't run into that yet.
mhm. Yeah, I do ask myself even personally when when we're funding loans, like, is this something that I would personally fund? But then of course, when I'm bringing it to you or us, I'm like, is this something we want to fund? So, but I do that on everyone, but I do realize that each investor has a different appetite for what their risk level is. And, some investors will take a higher risk to have a 12 or 13% return, where your risk level of the equity protection you want usually puts you in the 9 to 10%, return for having, a better position in that. So,
Which is fine for me. That's comfortable.
mhm,
If I was one of these big shots, I'd be more inclined to do that. There's a huge opportunity there. I understand why those guys,
mhm,
do that. But most of those guys are, talking about millions in their,
mhm,
accounts. And I'm a little more humble, a little smaller of a player in this. So I
mhm.
just tend to be a little more careful.
Yeah, and that makes sense. A lot of the investors that we work with, even if they have millions, their first investment they make, they want it to be a small investment. They want to kind of put their toe in and test the waters and see how it feels. But what I find a lot of times is once they've gotten that first note and they watch it perform, then they start to get like, oh yeah, like I like this. Let's put some more money into private money notes. And then they become enthusiastic about it. And so, like, how about you? Like, what were your emotions at the first time you put money into the note? What were you feeling?
That dynamic that you're describing definitely plays with me. I was much more of a scaredy cat in the beginning of it.
Mm-hmm.
I just didn't really have any familiarity with it. I didn't understand, the pitfalls, or, the risks in it as well as I probably do now. Um, so I definitely am more risk tolerant now than I was in the beginning, but I definitely had that feeling in the beginning of the first one. Let's take a small, I'll put as little of my toe in the water as I can do.
Mm-hmm.
And I've learned, I've developed more trust for the transact, more faith in them.
Mm-hmm.
Uh, so yeah, I mean, I think my investment principles are generally the same, but I'm more inclined to. I probably have more tolerance now. Things that probably made me nervous don't make me as nervous anymore.
Okay. So now, like on this time, you're not as nervous, but what's your overall feeling? If you were to give somebody advice about investing in private money notes, like who would you say would be a good candidate to actually be an investor?
Well, I encourage anybody. All my personal friends. I tell them what I'm doing, and that it's I feel like it's the best investment opportunity. It's the best way to make money. But I also understand that investments need to be diverse. So I don't want every egg in the same basket. But boy, I just don't. For a person, that has a retirement account, or doesn't have millions and millions of dollars, but has, a little bit of money that is sitting in a savings account or in a bond or something that's just not very dynamic or profit, potential in it, I feel like you're losing a huge opportunity. So I don't know what the dollar amount is. I think that the lower end, I know in our business we're not typically writing loans for less than 75,000, 100, somewhere in that area. So some of these notes have been in the, I don't remember what the first, I want to say like 150.
Mm-hmm.
But then we've also, with some of the investors, we've also split these. I know I shared the first transaction with another investor. So who can't do it? I guess
Mm-hmm.
it's easier to name people that shouldn't do it than people that should. I think the majority of people probably, if you're middle aged, you have a little bit of retirement, you probably have enough in there.
Mm-hmm. Yeah, there's definitely a qualified investor form that people need to complete. We need to determine based on, you know, Department of Real Estate and IRS tax rules and, different laws that you're a qualified investor. But yes, I'm with you. I do find that it does line up with safer investments for people. It seems like people that are looking for safer investments really like the private money notes. And a lot of private money companies will split their notes between 10 or 20 investors, and we go to two. Like two is the most, because they will allow people to put 10 or 20 or $30,000 down on, they'll put 10 investors together at 20,000 to do a $200,000 note. And we just don't do that, at SJ Morgan. We think two's good, two partners in investment is, a good investment. And that's just how we've chosen to do it. So that's your experience, with that. So
the question, does the Department of Real Estate, it seems to me from filling out a lot of that paperwork with all the compliance things within the company, seems like the Department of Real Estate, I get the feeling like they're not really big on splitting loans that many ways, 10 ways, because they're counting, they're keeping track of how many loans are, split into pieces. So it's a
it
concern.
definitely, it puts a target on you as a company to have, it's to fractionalize loans. It's called fractionalization. And of course, when you break it into tinier bits like that, there's more opportunity for fraud because you're not paying as close attention, right? And so then you have multiple people, and and then you have to have one person managing it all. When you have two investors, you're more in tune with like what's actually going on with your note. If you have like 20 here and 20 here and 20 here, and like you have 100 notes with 20, or 10 notes with 20, you're not paying as close attention to it. And I think that that's just the idea, is that there's a little more room for fraud, when notes are being fractionalized. So, but that's just how we've chosen to do it. And I think our investors like it. And something that you said earlier that I thought was interesting is, since we've owned the company, we really haven't done a lot to go out and get private investors and bring them in. Most of the investors that we've gotten were from just like what you said. They go somewhere and have dinner with a friend, and they start talking about investments, and their friend asks them, and they'll say, "Oh, I'm investing in private money notes." And then their friend will call me on Monday. You know what I mean? So it's like we've just kind of grown organically with investors. We've never actually gone out looking for them. It's been word of mouth from our investors to their friends and associates that have, grown the company. So that kind of shows you what type of investment that is. And I've actually had multiple individuals say to me, like, "Do you really get a 10% return? Is that really a real thing?" And the answer is yes. You really, for the way that we structure the loans, whatever the note says is what you get, unless you're paying somebody to service it. And that's like your decision. There are some loans that have to be serviced, but it's your decision who you want to have service it. And so as a company, we originate and make origination fees, and the investor owns the note and owns all the money made by the note. So,
for anybody that's considering it, at least in my experience, the servicing fee is pretty low, and it's a whole bunch of clerking I don't have to do. I got enough clerk responsibilities, so it's not prohibitive. It's very reasonable.
Yeah, I would agree. And for what they do, as far as like the servicing takes in the payments and disperses to you, sometimes if there's an impound account required, then there has to be a servicer, and they pay, all the bills, on the transaction. And then if something were to go wrong with the note and, it need to go into foreclosure or something, oftentimes the servicer is writing the appropriate letters to the borrower. They're hiring a foreclosure company. And so, even though that's not a common thing that happens, that with private money notes, people, will at times get behind, and have to catch up on payments. And that's a little bit more stressful when you're trying to manage that yourself and not letting another company do that. So, I mean, I think what you're saying and what I'm hearing too is that if you were to give somebody advice that was thinking about investing in private money notes, the advice would be to consider making sure that you do hire a servicer and not try to service them yourself. And if you're funding,
I won't do it without a servicer now. We serviced for a few years. I realized what's involved and how much work that can be. And then I saw what companies were charging. And when I started talking to these companies, the servicing companies, I realized how much is involved in it. And, just the fact that some companies do nothing but service kind of tells you it's kind of a little clue that there's a reason for that. That they have redundancy, they have multiple computer systems, their bookkeeping, everything is just a whole level above anything you're going to do. And it's just one less thing for me to worry about. And I know that if there's confusion, I have experts on hand that can help me with the whole servicing issues, and it's just totally worth it. That would be, do what you want, but my advice would be get yourself a servicer.
Yeah. And the funny part about it is that in your situation, you don't really have a choice because you're funding from your self-directed IRAs, and the IRAs require that there's a servicer because you can't touch the money. And even though there's no money to touch, the servicing company gets sent the payment then gets sent directly into your self-directed IRA account. And so, and like you said, like the servicer that you use particularly, I think they charge 0.5% annually. So if your note is 10%, you're receiving 9.5% and they take 0.5% to service it, which is really reasonable.
Yeah. Considering what's in there, what needs to be done, and just, I serviced for a while, not fun.
Yeah. I feel a lot of my investors are the same. Some of them really insist on servicing, but then they're constantly calling me to ask questions. And I think, why don't you just hire a servicing company? And you can along the way. If you don't start out with a servicing company, you can still hire one as you get down the road. So it's not some big mistake you make, that you can't, rectify, if you decide to, fund a note and don't have a servicer. So that's the good news. But yes, super appreciate you being on today. I always like to see you and talk to you because I like you. But
well,
it's good to have you. You didn't have a choice.
I know it's good for me.
Yeah, but I am glad to have you on, and you have been very helpful, I'm sure, to people who might be on the fence or thinking about investing in notes. So thank you so much. I appreciate you. And if anybody who's listening has found this helpful for them, please subscribe below, and we look forward to seeing you on the next podcast.
Thank you for joining us on Real Loan Talk, hosted by Sonya Morgan. We hope you enjoyed today's episode and found the information valuable. If you have any questions or suggestions for future episodes, please reach out to us. Be sure to subscribe and leave a review on your favorite podcast platform. For more detailed resources, visit our website at sjmorganple.com. You can also follow us on social media and explore our podcast website at realloantalk.com. Until next time, stay informed, stay inspired, and let's achieve your financial dreams together.